What is up, everybody? Welcome back to another episode of the Cash Flow Chronicles podcast. As always, I'm your host, Shawn King, and today got a special topic for you guys, something I've kind of touched on before, but I really just wanted to lay out some clarity on this topic. So we're going to be discussing 10 downsides of 401ks. And I want you guys to understand, I'm not here to poo-poo or just, completely shit on 401ks. I think people should be able to do whatever it is that they want with their money. But I just want more clarity around the topics. I think oftentimes this is the only thing that they're really presented with, especially through work. And so they see everybody else doing it and they're like, this is the thing for me. This is what I'm going to do. This is what everybody else is doing. This is the only thing that they talk about. This is my only option. So this is what I'm going to do. And at the end of the day, I just don't think that this is the best way to get to where you want to go. Now, I'm not saying if you like the idea of a 401k, a qualified plan, anything like that, that you shouldn't do it. But I think you should have your options laid out in front of you, and I think you should understand everything that goes into it. So with that being said, let's go ahead and not waste any more time. Let's hop right into it. So again, title of the episode is The Hidden Downsides of Qualified Workplace Retirement Plans. So we're going to be talking about a topic that many people really take at face value, and that is qualified workplace retirement plans like 401ks and employer matches. That's a big thing for people out here, employer matches. While these plans are often marketed as, an essential part of your retirement savings, it's not savings, your retirement investment. They're not always as beneficial as they might seem to be, especially when you dig into how they're structured. So what we're going to do is explore why these plans might not work in your best interest, and then what you can do about it. Because obviously we want to give you some actionable steps. This isn't just, again, shitting on 401ks and making it seem like the worst thing ever. We want to let you know, well, what are my other options, Shawn? Provide me with some value here. So downside number one is limited control for employees. One of the most glaring issues with workplace retirement plans is the lack of control employees have over their own investments. So, investment limitations, the investment options in 401k plans are often pre-selected by the employers, and they're really often just a limited handful of mutual funds or other managed options. And, these funds may not align with your risk tolerance or your overall financial goals. So, for example, imagine wanting to invest in individual stocks or, alternative assets. So imagine wanting to invest in individual stocks or alternative assets, but your plan really restricts you to kind of a set menu of high fee mutual funds. It's going to kind of suck. Now, again, most people aren't doing this stuff themselves, but options are good. Next up is, the restricted access. So access to your money is highly regulated with these type of plans. And I'll mention this multiple times throughout the podcast, but if you need funds before 59 and a half, you'll likely face a 10% penalty in addition to regular income tax, on the withdrawals. So really the takeaway from that is limited access means less flexibility to use your money strategically during your working years. And I think that's one of the most underrated things is people don't realize that they're putting this money away and they're not able to use it again. And so they miss out on all this time that money could be continuing to make money for them and not really just on this roller coaster ride of it's up, it's down, we're going forward, now we're going backwards. So the number two downside is tax deferred growth isn't always a benefit. Tax deferred growth is, it's really often advertised as a key benefit of 401ks. But listen, guys, it comes with potential downsides. So one of those is going to be future tax uncertainty. And what I mean by that is, while contributions reduce taxable income today, which is something that they're like really big on, they're like, no, we'll reduce your taxes today. We'll just kick the can down the road. Well, withdrawals in your retirement are taxed as ordinary income. So if tax rates raise in the future, which, let's be honest, what direction do you guys think taxes are going in? I've talked about this multiple times. Do you think taxes are going down? Do you think the government's like, you know what? We should actually tax the people less. Or do you think taxes are going up? Because if you think they're going up and you're kicking the can down the road, or if your income is higher in retirement, which I think is really the goal. I want to be making more money in my retirement than I am when I'm working. That means I set myself up, my plans, my investment, all of my things played out as they should. And if that's the case, if that's what you want as well, then you could end up paying more taxes than you actually saved initially, where you should have just paid them when you were in a lower tax bracket. So to give you an example, you got a young professional and they're in the 22% tax bracket today, but because they set themselves up with some smart investments and put their money in places that gave them, solid returns and good cash flow and all that stuff, maybe they retire in the 32% tax bracket due to higher earnings, or maybe tax policy changes, because let's be honest, these things change. The tax codes change. So let's talk about alternative options then. Really, you want to compare this with strategies like infinite banking. Of course, I am a huge infinite banking advocate. And with infinite banking, the growth inside of a properly structured policy is tax advantage. And loans can be taken tax-free because loans are never taxed in this country, or you can withdraw money up to the benefit base completely free as well. So essentially, we can help you get money out of your policy, out of your infinite banking policy, and never pay a dime in taxes. Something to consider. So the number 3 downside is the employer match as a business strategy. So oftentimes the employer match is frequently touted as like, oh, we got free money here. I hear that all the time. Well, it's got a match, so I might as well get the free money. But there's more to the story than that. So tax deductible for employers. Contributions to your plan, if you didn't know this, are tax deductible for the business, making the match really a cost-effective way for companies to reduce their tax liability. And you may be thinking to yourself, well, Shawn, that doesn't sound like a bad thing. It's benefiting the company. I can promise you the company really isn't doing anything for you to help you out. It's about the company. It's like when I played college sports. Like when you got to that Division I level, it wasn't just about trying to make people happy and everything like it was in high school. It became a business, and they were looking out. The coaches are looking out for them and their careers. Same thing with these businesses. These are legitimate businesses. They're not looking out for some person that they can easily replace like yourself. They're looking out what's best for the business. So one thing they like to often include is vesting schedules. Many plans include these vesting schedules, and essentially what that means is you'll only receive full ownership of the employer contributions after working at the company for a certain number of years. So to give you an example, if your plan has a 5-year vesting schedule and you leave after 3 years, a couple things could happen. You could either forfeit part or all of the match that they've given you. So I've seen vesting schedules for 5 years, 10 years, 15 years, and really all they're doing, again, is trying to lock you in so they have less turnover. That doesn't mean that they're not going to fire you or something like that. But let's be honest. How many people do you know, especially if you're in the younger generation? I know this may not be so much for the older generation, but how many people are switching jobs on a 2, 3, 5 year basis? I feel like most people go through life having multiple jobs. I know a few people that have kept the same job for a long time. It's just becoming not nearly as common. So again, the match isn't as generous as it seems, and it's it's often designed to encourage employee retention, but good luck staying at that job that long. Like, things happen. Again, look at your history. How long have you been at your current job, and do you plan to be there for the next 5, 10, 15 years? All right, so next downside of 401ks, number 4, is contribution limit. So qualified plans really, they have strict contribution limits that can hinder your ability to save effectively. What I mean by that is really just the cap on the savings. So the government sets these annual limits on how much you can contribute. And in this year, 2024, we're about to finish up this year, the limit for employees under the age of 50 is $23,000. Now you may be thinking, $23,000, this seems like a substantial amount of money, Shawn. It's really restrictive for high income earners looking to maximize their tax advantage savings. So most people aren't putting, people that are making, let's call it 50, 60, 70, probably even up to $100,000, aren't putting in $23,000 into their retirement vehicles, their 401ks or whatever. But those high income earners, that's going to be so much easier for them to hit. And once they hit that, you find yourself unable to save more within that tax deferred framework, if that's the type of framework that you like. So that could be a huge problem for them. Unlike, let's provide you with a solution, alternatives like whole life insurance policies or taxable brokerage accounts. Those can provide more flexibility and scalability if you're looking for, less hindrance on the contribution limits. So number 5, downside of 401ks. This is a really big one. I think that it's not talked about really at all. And I don't think people understand how huge of an impact it has. And that's hidden fees and expenses. So fees are often hidden in the fine print of workplace retirement plans. Definitely be sure you read over those and you take a look. But they're quietly eating away at your returns over time. And believe me, I like eating. What I don't like is things eating my returns. So we've got things like administration fees. These cover plan management and record keeping, but can literally add up to hundreds or thousands of dollars annually. So that's a big deal. Definitely want to make sure that you're looking into that and reviewing the fine print. But then you've also got these investment management fees. So many mutual funds offered in 401k plans have expense ratios that reduce your net returns. So I'm going to give you an example. A 1% annual fee may sound small, and you're like, 1%, that's not a huge deal. But over 30 years, it can reduce your total retirement savings by hundreds of thousands of dollars. And that's just a 1% annual fee. So I've seen things up to like 2.5%. And you guys, you have to understand this. You're going to get to the point where you're paying more, or you've paid more in fees than you actually have money available to you at the end. It gets really sad. And again, they may seem like small numbers, 1%, 2%, 2.5%, but boy, that's that power of compounding interest working against you there. So as a takeaway, you always want to review the fee structure of your plan and really just seek lower cost investment options when possible. So number 6 downside is market dependence. I don't like to be dependent on anything, especially not the market, but most qualified plans tie your retirement savings to the performance of the stock market. I think everybody kind of knows that. It's very obvious. But with that comes risk of loss. So while markets historically trend upward, that's what they say, average 8, 10% if you look back. Okay. They're also prone to downturns, which again, we all know sometimes, though, right when you need to withdraw your money. And that's not a laughing matter. It's very unfortunate. Prime example, employees who had planned to retire in 2008 saw their account balances drop dramatically. I'm talking by like 50% during that financial housing crisis and everything. So imagine you had worked all of your life essentially to get to this one point. You got this nice chunk of money. Maybe you got, 1.5, 2 million bucks, and then bam, you have 50% less. What do you do at that point? You're like, all right, well, obviously I was planning for this. Now I have this. Do I retire and keep this, some sort of limited lifestyle? Or do I say, screw it, I need to go back to work and try and build this thing up again, and hopefully this doesn't, happen again? The other thing is no guarantees. I love guarantees. And the more that you learn about infinite banking, and I think really the older you get, the more you understand the value of something that's guaranteed. So unlike certain financial products that offer guaranteed growth, 401k plans expose you to the full volatility of the market. So for an alternative, consider maybe diversifying your portfolio with some financial products that offer guaranteed growth and protection of principal. So again, I bring up participating whole life policies, guaranteed growth, protection of principal. That would be annuities, something along those lines. Two things that we can help you out with here. Alrighty, so number seven downside is rigid rules and regulations. So you're dealing with the government. When was the last time the government was like, doing anything for you, especially anything to help benefit you? So rigid rules and regulations, what I mean by that is really the government imposed rules around qualified plans that can limit the flexibility and create kind of additional unnecessary burdens. One of those being RMDs, required minimum distributions. So starting at the age of 73, which they just moved it back recently, it was 72, you're required to withdraw a certain percentage of your balance annually, even if you don't need the money. So you hit 73 and you've kind of set yourself up with this great plan where you got money coming in from all these other places, and you're like, hey, I don't need to take on more money to, get into a higher tax bracket and do all this stuff. I'm in a great spot. They're like, no. Government saying, hey, Shawn, you better take that money or you're going to get penalized if you don't take the money. So there's this short window from essentially 59 and a half to 73 where I guess you could say you're in control of your retirement. And then at 73, they're like, better start taking that money, Shawn, or you're getting penalized again. And then talking about penalties, on the other side, you have the early withdrawal penalties. So accessing funds, of course, we know before 59 and a half often comes with hefty penalties, reducing your ability to use your wealth strategically during your working years. So that's one of Nelson Nash's biggest things is your need for financing through your life is massive. So with these type of qualified plans, we're locking this money up and not allowing it to really work for us to help us finance the thing of our daily lives throughout our lives. And we're putting it in a place where there's no guarantees. Like it'd be different if you're like, all right, guaranteed, if I lock it up here, it's going to grow to this. And, maybe I can't use it, but I know it's going to grow to this. So I have that peace of mind. You have no peace of mind with this. Like it could literally all go to shit. And you're just like, well, wish I would have used some of that money or had access to it or did some other things instead of just put it, in this investment vehicle that, a lot of other people do, and it doesn't seem to turn out really well for them. So I'm not really sure why I did it at the end of the day anyways. So really the takeaway from this whole thing is the restrictions make qualified plans really less adaptable to life changing circumstances. There are a few ways that you can get in and access money in your 401k. But again, there's a lot of rules and regulations, just like the downside stated. So the number 8 downside is deferred gratification with no guarantee. So really saving for decades, I just mentioned this, saving for decades with the promise of future benefit, of course, is going to come with some inherent risk. And some of those risks are unpredictable futures. So factors like inflation, rising taxes, and economic downturns can really erode the value of your savings. I'm going to call it savings, even though it's an investment. An example would be a person who's retiring withdrawing from their 401k in a high tax, high inflation environment. They may see their purchasing power diminish significantly because, if you don't remember this from some of my other podcasts, the value of your dollar is strongest today. It's only getting weaker as time goes on. So as I kick my can down the road, inflation and all these different things are happening. Well, my dollar's becoming weaker and weaker. So you just deferred it down the road, and now your purchasing power has diminished significantly. So unlike, infinite banking or other alternative strategies that are out there, qualified plans don't allow you to leverage your savings during your prime earning years. We want you to be able to save your money and spend your money at the same time while it's still working for you. That's the whole idea with infinite banking. So, if you're not understanding that, when I first heard that, save my money and spend my money at the same time, that doesn't really make sense. I didn't think that was possible. It is. And we can break that down for you, how exactly you're doing that. And to be honest with you, what you're utilizing is OPM, other people's money. And again, we can get into that on another episode. So number 9, as we get close to wrapping this up here, we got 2 more. Number 9 is really a false sense of security. And what I mean by that is qualified plans can really create a false sense of financial security, leading a lot of employees to undersave or really overlook better wealth building opportunities. I've come across a lot of people that are like, no, I don't need infinite banking because I'm doing this. I'm getting this employer match, and I think that'll be sufficient enough for my retirement. But again, let's be brutally honest with ourselves. That's rarely the case. How many people do you know that went this qualified plan route, parents, grandparents, whoever it may be, that are now sitting in the retirement situation of their dreams? I don't know many. I know my parents are retired right now, and they're not in the situation they wish they would have been in. There's countless others out there. I think there's way more people that are going back and working more, going to, getting jobs at Walmart, whatever it may be, than there is people who are like, my retirement worked out as good, if not better than I thought it was going to. And it's all thanks to the market and these qualified plans. The other thing is, there's great upside, which is cool. Like, obviously people like to think that, hey, if my money grows by 12, 15, 20%, that's incredible. But the downside is insane. Like, you could do all of this and you could get to the end and they could say, you know what? Yeah, there was a bad turn in the market. And I know you've been saving for 40 years, but you lost like 70% of your money. And so, sorry. Like, well, nobody's even going to say sorry to you because there's nobody there that's, handling your shit. Like, you just passed off your retirement to somebody else, and you and millions of other people that were not really having their stuff managed or looked at that often ended up losing the majority of their money. So the guarantees is a huge thing. And I will give you this. There are guarantees in 401ks, qualified plans. And the guarantee is, I guarantee you, if you lose all of your money, you're not going to lose anything else. Like you could have $1 million and lose $1 million. And as long as you weren't doing some shady stuff and gambling on the side, we're also not going to take your house or something like that. Now, maybe you won't be able to pay for your house come retirement because all your money's gone, but you can't go into the negatives. I can guarantee you that. So that's cool, I guess. That's a bit of a sense of security. I'd call that a false sense of security, but it's neither here nor there. So really the takeaway is you want to diversify your strategy. You want to explore alternatives like infinite banking. Take a greater control of your financial future. I think a lot of people try and put that stuff off and make somebody else in charge of it. And nobody cares more about your money, your retirement than you do. And so we'll wrap this up with the final downside of 401ks. And that's going to be it does more for the business than it does for the employee. And ultimately, qualified plans are structured to benefit employers just as much, if not more, than the employees. You got the tax advantages. So employers receive tax deductions for their contributions. Again, I hope you guys know that, while employees bear the long-term tax burden. All you're doing, again, is kicking the can down the road. We know taxes are going up. This isn't going to end well for you. Like it's not the position that you want to be in. And then the next point is the minimal costs, like vesting schedules and contribution limits keep employer costs low, while employees shoulder, I was going to say most of the investment risk. They shoulder all of the investment risk. There is no other risk anywhere besides the risk that you're taking. It's your money. Remember, the money that they're giving you, they're matching, is not really real. Like if that's lost, it's no skin off their back. So the takeaway at the end of the day, recognize the true purpose of these plans, balance them with other wealth building strategies that put you in control of your money. Because just like I said a minute ago, nobody cares more about your money and your retirement than you do. So to wrap this thing up, qualified workplace retirement plans and employee matches, I think they have their place. They're definitely not a one-size-fits-all solution like they're, often made out to be. So by understanding kind of the limitations and exploring some alternative strategies like infinite banking, like I mentioned, like annuities, like I mentioned, everybody sometimes, depending on what age group you're in, you hear annuity and you're like, no, annuity, that's a bad word. You guys all don't realize everybody already has the biggest annuity in the world. Now, whether you're going to get that annuity, again, depends on your age. That's Social Security. So also, if you got some sort of pension through your job or something like that, that's an annuity. So if you hear annuity and you get all, upset about it, let's be real. You just aren't educated enough, which is totally fine. I'm here to educate you. But you got to look at these different options, folks. You got to find some things with guarantees, at least a portion of it, to help you diversify into. Really, if you guys found this episode insightful or helpful in any ways, please don't forget to subscribe to the podcast, subscribe to the YouTube channel, share it with a friend. Feel free to visit my website, legacylifeandretirement.com, for a free consultation to really just explore some smarter ways to grow your wealth. I'm here just trying to help you guys. I've got a lot of incredible things set up for myself, policies, investments, trusts, solid CPA, all of these things that are necessary to build a long-lasting foundation of growing, cash flowing wealth. But if you would like to learn more about infinite banking specifically, or annuity options out there, or maybe just get some book suggestions so you can begin your educational journey on your own, please don't hesitate to reach out. As always, the information is free, but the knowledge is priceless. I'll catch y'all next time. Peace.